Today is Monday, June 12th, 2017. Just going to do a quick review of things here on the charts. Um, First off, what's special as of late? You've got the Federal Reserve Central Bank on Wednesday, which is going to talk about supposedly what they think, which isn't necessarily true uh, based on past experiences. And that is supposed to justify their actions or inactions or plans in the future. And that it pertains to the money supply. So they govern the monopoly of imported money into the country. Um, you're not going to hear it called imported money because they operate under the guise that they are a institution, an institution of your government, but they are not. They are a private company, and they work in cahoots with the same um, kind of institution around the globe as a kind of cabal, in that they are a monopolistic institution. Okay. And what they do is they exist in these countries, in nearly every single country except for something like two or four, but they're coming along. And essentially, what happens is they assassinate presidents and start civil wars and break down civilization until the governing council allows them to put in a central bank. And so all of the presidents assassinated and attempted to be assassinated are all done by them. The U.S. Civil War, done by them. The Irish genocide at about the time of the U.S. Civil War, done by them. Napoleonic Wars, World Wars, Vietnam War, Korean War, the Middle Eastern conflicts, 9/11, okay, the fluoride in the water, the cancer stuff, and the gender and brain maldevelopment stuff, and the vaccines and the food, done by them, their consent. Okay, and remember, it has to do with consent. Okay, and and all of these things are for two reasons. Now, those aren't the only things, but they're for two reasons. One is to force nations into debt. If you have to win a war, you have to borrow money. Okay, and they start the war by paying the opposition to start wars. Then they force their target country into debt, and then their insiders are paid within the target government to invoke the charter of a central bank. So basically, they corrupt the inside of your country and your government in order to get them to play catcher to their sales pitch that they need to put a central bank in your country. And they force you into debt to rely on that. They also assassinate, cause mass death, mass problems until you agree. So it's a kind of strong arm mafia but on a international warfare level rather than a local city and state level. And this is done all around the world. They exist as their own, as in that's their own kind. They live in your countries, and they are essentially sovereign above the governments. Okay, the governments can't tell them what to do and what not to do. But basically, they are in cahoots, and you would never have a government kick them out of the country because that will result in assassinations and warfare. So there's no way to get out of their rule. They are a plutocracy, which is the rule by the rich. The name that we give them these days is the elitists. And the name that we give them these days overall around the world, as in their own entity, like a country, is the global central bank empire. And we are in now as of 250 years in the central bank wars. But the central bank wars have lasted 300 years, ever since England started off with their central bank, the first one, the Bank of England, in 1694. Okay, and so ever since then they've been doing this, where they fund the winner, of course being England, as much money as they want because they're just making it up. Then they go into war, and then they control everything, all the markets, the money supply, and all that. So basically, they go into war debt, they pull money supply out of the system, markets go down, they invest their fake money into those markets, then they add their money supply, they import money, then markets go up, and then they own it, right? So then, not only do they control money supply, but they control assets, because when economies go down, people have to sell out cheap. So they buy everything up cheap. They buy all the stocks, they buy all the farms, the industries. They get heavily influenced in everything. And so what this becomes is basically a kind of parasitic nation over the top. And I guess I'll talk about that more later on. So they're having a meeting on Wednesday about the money supply. And generally, whenever they're going to have a meeting in your country, the markets in your country are going to be kind of sideways trading. They don't do a lot of movement. A lot of traders just skip it. They get out of it. It affects volume for the most part. Also, the ranges become very sideways. The charts become very range bound, and they don't follow the ordinary traffic rules, so to speak, as in when you think that you know what it's doing because what it's doing in the present indicates such and such on the chart is about to happen, the market's about to happen, or the crowd is about to take the prices and do this and this. Like usual, on the week of these central bank meetings, it's different. They change. Basically, everybody gets out, and the computers kind of take over. And so, whenever you have computers taking over the charts, you're not going to be able to predict what it's going to do, and therefore it becomes more risky. Okay, we can handle that. I think we make enough money on the days that it works that that shouldn't be a big problem. Um, and as always, I like to suggest that everybody take advantage of these markets, learn about these markets, learn about the lending system that's happening right now. Tap in to these elitists' wallets while they're out in the open. Okay, you know, I'll tell you something. There's a lot of leverage going on. Okay, they're lending like crazy out there. All the banks, the central banks, the governments, just borrowing all the time and throwing money all around. Okay, and there's a reason for that, and it's not for your benefit. Okay, but not in the long term anyway, because this is part of their Fabian warfare to weaken you. Okay, now I'm not gonna get into that today. I think I've already talked enough. But like I'm saying, always I'm trying to tell people to take advantage of these times. Figure it out how this system works. Okay. Figure out how to run finance and finance the focus of your investments. Okay. Now you can do that through a myriad of ways. Okay. Finding more capital supply, raising more capital supply with various strategies in your portfolio, where some of them are supplying other ones, and always taking advantage of the hedging of your positions so you're never losing, right? And if you can take care of that, then all that you can do after that is that you could make money. Okay. So it's kind of like having a weighted coin. If you have a coin that can never land as a loser, always a winner, then and you do that repeatedly, eventually you're going to have a sum. Now, it does also mean that you've discounted a lot of risk, so you won't necessarily make as much, but if you're depending on luck out there, which is a lot of times what it's about, and you're not hedging, you could make a ton. You could make more than anybody else in a year, but if you're not good at hedging, okay, then you could lose more than anybody else the next year. Okay, so you need to keep the risk within constraints. And you can profit from that. If you know how to profit from risk constraint, then it adds to your capital supply to invest in your focus investments. And so, therefore, it adds to your profitability. And so, this whole concept of decreasing risk eliminates profitability sort of flies out the window as long as you know how to do it, and that's what I teach. But anyway, here's the S&P 500 E-mini. I'll tell you something, I haven't been trading the S&P 500 E-mini. It's just been kind of awkward lately. Why don't we look at the day chart? The awkwardness is that it trades fairly flat these days, and it's fairly unpredictable. I don't like it. I used to like it. It was a very healthy market, I guess. As long as you were on the right days, you weren't on like an odd day, like before the FOMC or before the ECB or during the holidays. Everything was just up and up, and the possibilities were bright. But recently, it's been kind of sideways trading and unpredictable. I call it a schizophrenic robot. So these S&P 500 E-mini futures have become very schizophrenically robotic, and they are designed to rip, right? They're not designed to give away money. They're designed to invest less and take more, whereas human traders are normally sort of a collectivist kind of crowd movement where you can see where the crowd's going. You get in. If you're wrong, all you got to do is say, wait, I'm wrong. I'm going to get in. And then you kind of force the markets. And that gets these computers to go along as well. And they kind of augment that action. So essentially everybody and the computers are working together, going in the right directions, following the right signs, and so on and so forth. The chart becomes very predictable and profitable. Otherwise, when the people are absent or the computers are too prevalent in the market, perhaps I tend to think that maybe there are more computers in the S&P 500 E-mini and all the stocks as well than there were before. And you got to remember that they tie them all together. So when they put the computer traders into the stocks, they connect them all together. And they're actually all together with all the other markets. For instance, the Forex, the bonds, the commodities, all the different kinds of big futures, the news on Google and stuff. So that if something breaks out somewhere on the internet, on the news, you know, a market goes berserk, whatever the case is, then boom, all of these computers take action, right? Because the fire alarm is going off down there in district whatever. So these ones start running for cover and take precautionary action. Not only that, though, when they do take precautionary action, they're also programmed to take advantage of this precautionary action. So let's say like the S&P 500, as a result of something out there, S&P 500 starts selling. Well, that's a precautionary action. But at the same time, what all they're going to do is switch, right? And then they're going to start taking advantage of that selling volume. And as long as there's heavy selling volume, okay, then they're going to start to kick in selling orders as in short selling, and they're going to profit on the way down. Okay. And so you got precautionary selling, and then you also have liquidation and short selling as a result of precautionary selling, okay, on top of each other. And this just begets more and more until the programs and or the people start saying, okay, let's start picking up right here. Okay. Then once it becomes a buyer's market and these programs just start basically bulldozing, shares into their hordes in mass, then the computers figure it out. Okay, volume drying up, volume switching. They understand the delta between sell and buy. They know if the buyers are all of a sudden a lot higher than the sellers, then obviously we need to stop selling short. We need to cover quickly and get out of our short positions and anticipate buying. And basically, whenever these things are anticipating, in their anticipating mode, what they're doing is they're trying to front run the action. They want to pick up short contracts or short shares and then sell them in the next second, in the next split second, over and over and over, over and over and over, until the volume starts to recede. Then they'll adjust how much they pick up, right? And then once it becomes limited and the delta starts to shift, then they'll just quit. And they may do something else. Whatever is justifiable. It's determined by the delta and the volume level. Okay. So they always overshoot, right? So if there is something that is going on, they're going to shoot you down too low. and you can take advantage of that. If you know it's too low, but you got to understand market mechanics. If you don't understand market mechanics and truthful evaluations, and you're not up to date with all of the news announcements and so forth, which you have to do all the time, you can't ever give that a break. But if you know that they've already shot too low because you know what the big picture is, and you definitely know what's not going on to justify that low price, then you too can take advantage of them. And sometimes they're so far below what is a normal evaluation, you can literally put all of your funds in and then start calling up whoever all of the money supply, capital supply, out there, and get that to come over into your accounts and then dump that in there as well and get a quick upside move. It is kind of risky, right? So if you're prepared, if you know how to handle that, assuming that you know how to handle that, then you would have those connections. That wouldn't mean necessarily, I guess, it wouldn't mean necessarily putting every single dollar in. But if you can increase the tub's capacity, then you can increase the percentage of the tub that you invest into it. So therefore, you would call in and then try to add to your capital supply, therefore add to the percentage of that total capital supply in the market. Take advantage of that. And the same can be true the other way around. Some markets can shoot too high because of other things. And so when they do that, then obviously you would do the exact opposite. You would sell, right? So, but you have to know the score. If you don't know the score, then you don't dare touch it. And but just expect them to overshoot either direction, and understand why. And the thing is that this S&P 500, that's the thing. It hasn't been so cooperative. It's been very sideways and robotic and that kind of thing. So let's take a look here. Basically, today's a good example of it. It is Monday. The central bank talks on Wednesday. So this week is pretty much shot. And it being June now, more than likely people are going to start to skip out on the market. They are talking about, not adding more money supply. They're actually talking about taking money supply away, which means that markets aren't as predictable. If they're constantly adding money supply around the world, well, you only know one thing: the markets are going up, right? So if the markets have been doing that for a long time, and then they're talking about taking money supply away, but also you've got the president now, this president, Trump, talking about doing things capitalistically, not Marxistically, right? So then you've got market fundamentals or economic fundamentals that are actually going to improve. But at the same time, the markets are overbought based on Marxistic money supply influences and Marxistic socialist governmentalist, then basically you're kind of thinking that it's got to come in some. The price got to come in some, find a bottom, and then go from there. And so you're figuring range bound. You're not really figuring, trend up. Definitely try to find the price down lower. So I think basically what that's going to tell people is this summer is not a big deal. Wait it out, see how it's doing in October, and go from there. So you'll get a lot more robotic trading. I think that's what's going on here. But we're 2 days before the Fed speaks, so Now, we don't need every trade in the book. I'll tell you something. You don't want to look at your charts. I've got charts on here that that basically, if you trade, it marks where the trade was entered and where the trade was exited. Okay. And so if you have all of those little entry and exit marks all over your chart, you're not doing it right. Okay. You don't want to make a ton of trades. All right. Unless you're really good. If you're just one of the exceptions, okay. But most people commonly don't want to make a ton of trades. Because if you're having to make a ton of trades, then you're probably losing anyway, right? Because you're losing, therefore you're making more trades. Okay. But the thing is, though, is you just have to accept it. You have to accept that, okay, I get some wrong, and it's not me, it's actually the market. If you're not experienced enough to know that, eventually that's how you're going to realize that, okay, well, the market just isn't doing the things that everybody looks for. Because I'm on the ball, but the market is not playing the game. So, and that's basically your sign. It's your sign that I gotta just sit this one out, wait for it to start again. Try again the next day, or look for it to start acting up the way that pays me. Okay, don't trade more. Don't overcompensate it. It's not your fault. It's the market's fault. You really shouldn't wind up with, dozens of trades at the end of the day. And by a trade, I mean, you assume the market's going one way, so you're trading according until you assume the market's going another way, or you just don't know which way it's going to go. That's basically a trade. Now, you can get in and out, with various strategies, which I do during that move, right? A couple of different a couple of different inflection moves on my part during that movement is fine. But if I'm going back and forth, if the movement is so unpredictable that I'm having to switch back and forth, right? And totally change my strategy over and over, and I'm wrong every time, okay? It's a bad market day. And it's not your fault. It's just that you can't read it. And I'll tell you what, nobody else can read the thing either. They can't. And the only people that are actually going to make any money in that thing are the people with a ton of money. Because when you've got a ton of money, you've got a ton of ability to expose your accounts to these things. So when you're wrong, right, then you can just fill in the pothole, right? Like if you're wrong, there's a hole in the road, you just dump some more pave in there, right? And then flatten it out. And then eventually, a market goes down, it's going to go up. And if a market goes up, it's going to come down. And so that's pretty much how they work when they've got enough money. But for the most part, most people, if you know how to trade, okay, you've done it and it's worked, but it's not working that day, then it's not you. It's you and everybody else, in fact. So you just got to wait it out, and look at the news, see what's coming up. Maybe it's a Fed meeting. Maybe it's an ECB meeting. Maybe it's a China deal or something, If they're anticipating big news, a lot of times it's just going to be kind of a flat deal. Sometimes, though, if they're anticipating news, it can be a market moving deal, right? So everybody's just kind of like neutral to bullish about Fed. Right now, they're kind of neutral, right? So if they're neutral, that's going to be a bad day because they don't know. They may say nothing. They may pull supply. They may add supply. We don't know. It could be any of them, really. But if you already know what they're going to do, right? They're probably going to add more. They're definitely not going to take away more. If you already know that, or even if they're going to add more, you know that it doesn't matter because they're not going to take away enough to matter. Then you pretty much know which way it's going to go, and that's how everybody else knows. The other side of it is when perhaps you've got some kind of budget restraint on you coming up on your country, and you pretty much know that it's going to be a government shutdown or whatever. You see it coming, and the market starts to sell off. Okay, well, see, now we're anticipating news, and the market's actually moving. So, those are good trading situations. Okay, so as you can see here, well, you're going to see it in just a second when I define it. It's not a really good trading scenario. Okay, so first of all, you get up here, and you've got this quick wick, right? Which is saying that the crowd doesn't want anything up here, first of all, because it ended here. The bar ended, right? You got this top here too, right? So basically, price went up here, somebody bought, but then a bunch of sellers slammed this back down. So the crowd is saying, hey, we're not a ton of buyers here. We're a ton of sellers. So don't you come back this way. Right, that's what these quick tails, quick wicks mean. See there? Right. All right, so no problem. That's a clue. Okay. Oh, yeah. First thing you do is mark off the opening swing high, the opening swing low. Opening swing low is going to be probably right here. Okay. And so you see that right there, and you're going, well, that does look kind of bearish. It does say that the bears are interested in selling. Also, keep in mind that you've got FOMC coming up. Now, this is the S&P 500. You got FOMC coming up. Okay. So they're anticipating stuff. Also, keep in mind that the word out there is becoming more and more about how the dollar is going to crash. The markets are phony propped. All the precious metals are propped down with hundreds of trillions of dollars. The bonds are propped up with several trillions of dollars. Okay, and that's just in our country. Globally, altogether, it may be a quadrillion. I don't know. It could be a half a quadrillion, propping up all these prices, right? Because basically they don't want the precious metals to get out of control, because then that will get the insurance rates out of control. Okay. So, and the thing is, though, is that they've got to continue to borrow more and more and more to keep that up. So it's just a never-ending void, dumping money. It really becomes idiotic, and people are losing faith in it because they don't see any value in it, so they don't trust it. It's, a price is a myth, right? It's about trust. You have to believe in the price of anything. So when they see that these are phony propositions, okay, they believe that it's overpriced, and so that's how money collapses. They believe that it's overpriced. It's not worth what it is. And when it starts to infect the very wealthiest people in the world, then it starts to rock the whole situation. Okay. Because they don't believe in it. They also, whoever's controlling the prices of the currency and controlling the prices of the precious metals, they've got to be trusted, right? So if you don't trust them, then it's even worse. And what the thing is, though, is that the internet's telling everybody about all these people, the ones that are alive now, and basically about the ones that created the institutions, right, that are calling the shots. And so everybody's seeing that basically these are murderers that have killed over 1 billion people, if you include, all the people that became deprived and all of the abortions, which is part of their pursuit. It's over 1 billion people. So they're even worse than the Mohammedanists, right? And they just began. They didn't begin 1,400 years ago. They just began. And they have the money monopoly. The Mohammedanists don't have the money monopoly. Also, they're more flexible. So they're more powerful in their flexibility. The Mohammedanists are very rigid. So they're even more dangerous. And they're probably going to increase well over 1 billion. Anyway, so all this news, old news, in history is news, all that modern news, all this is coming together. People are curating all this information and then detailing out what it means, and it's going around the whole world. And so, when people are seeing these things, they realize that, oh, well, I got to take, precautionary moves. I better not get into markets, or I better get out of the dollar, or I just better get out of these kinds of paper things that can be ripped off and whatever, and get into land, equipment, metals, knowledge, and so forth, and hold on to real wealth, not this paper stuff, right? Which is something that I keep on telling people, that they need to learn how to use these paper markets the way they are right now while it's easy. With all the technological leverage, there's all kinds of leverage out there. I got all the information, got all the technology here online. There's so many people talking. I can just reach out there and find out anything I need to know, and I can borrow endlessly, just as much as I can pay back, and as long as I can always pay back, which is very easy, then I get competitive interest rates. Also, I get increased credit limits, and then I transfer the income from this into hard assets, right? So that's what you want to do, because the point of this central bank war is not to make you more profitable. Even though right now there are benefits, right? There's side effects. They would consider them negative side effects. And one of their negative side effects is that you can access easy capital supply, easy information, right? That's a negative side effect to them. And if you can, take advantage of that, do so, learn up, practice up. I'm getting off track here. So anyway, we've got the swing high, we've got the swing low, we've got this quick tail here indicating that the crowd is saying that, hey, we're just not as many buyers as there are sellers. Look, and so there's signal right there. This is, the sign. Take advantage of that, and then you get down here, and you've got the quick tail right here. Not necessarily a bullish sign, because this is only the third bar, right? This is the opening right here. Okay, the market opened right here. This is pre-hours. This is regular hours. And so this quick tail is actually only as important as this tail, right? This is indicating some bearishness here. This is actually indicating some bullishness, right? A quick jerk back up. So perhaps you want to buy this. But that early, I would kind of refuse that. I tend to believe that that early in the day, the bars don't mean as much. Okay, but what I will do is at this point right here, where I've got a quick tail right there, a quick wick, right? So right here I'm thinking bullish. Right here I'm still thinking bearish, right? Sellers really came here, dominated. And the thing is that I've got quick wick right here, quick wick right here, which are both bearish, and they're both north of the VWAP. And basically, if you know about this, you can kind of take advantage of it. The fellas that do the trading on the floors a lot of times, they also do this in the offices as well. And basically, they'll have big clients from around the world. They could be anybody. They could be the princess from Saudi Arabia or Qatar or whatever. It can be anybody. What they'll do is they'll call in and they'll dump a trainload of money on these guys, and then they have to basically work the trade the best that they can, which means that they're going to try to get on average the cheapest rates. So it looks like they got orders right here that are to sell. And they're going to they never do it all at one time, right? They're just never going to dump the whole order on there. They're going to try to work out an average, right? So basically, the way they do it is they'll dump a truckload here. The price ran down. Great, it ran back up, and then it's north of the VWAP. So that's where they sell again, right? So they get a bonus. They can get a bonus if they sell above the VWAP in this case. Sometimes it's the other way around. You get a bonus if you can buy below the VWAP, okay? So if they're getting bonuses, then that's what they're going to do, is they're going to try to get it, north or south. And then you got to figure, okay, who is there more of, right? Well, obviously, right now there's more sellers, right? And that's what these quick wicks are about. They just dumped out a truckload right there. Okay? And this morning, like every morning, is extremely voluminous in that any kind of movement is extremely strong. So imagine that in the morning, the necks on the bulls and the shoulders on the bears are just extreme. They have extreme girth. You're just not going to be able to stop them. And then when they're in combination, you just can't go against them, right? You're gonna have to literally bring the moon down and affect things, right? That's how strong they are. So if you got a big jolt up right here and then it slammed down real fast right there, that's saying there's a ton of bear right there. Okay, and it beat a ton of bull. Okay, so you got one's big, then you've got another that's even bigger than that, that's saying something. And then you got down here, okay, and then you got a ton of bull, and then another one even bigger than that slammed it back down. Well, I would be bearish. I'm seeing here that every time the bulls rise, the bears slam them down. They win each one of these fights, right? Fight one, fight two. Fight one, fight two. Okay. So what I would do is I would just take a slice of the Bears action, right? They seem to be the winning team. And I would put in an order right here. So as soon as it popped up, as soon as this thing closes, I'm going to be looking for the thing to close. This bar closes right here. And as soon as it popped up, I would put that thing on there. And then as soon as it crosses back over, I'm in. Okay, so I'm good. And these are 4-tick channels here, as you can see. Each on the E-mini, it's 4 ticks per dollar, right? So each one of these is $1, and each handle is $1. It's 4 ticks per handle. Actually, a handle's every $10, but whatever. And here you go. You got a good slice here. I would take probably about 8 ticks off of this and call it quits. Usually what I do, though, is I let the thing run. This did run down pretty quick. And then I'll see where it's starting to break up. I use a heat map, which is based on the DOM. It looks like this. See there? And then that's going to tell me more about the action down here. And so as soon as I start to see that they're going to start to the bears are not going to overpower them so much, which basically makes sense, right? Because we're so far below the VWAP, the order, whatever it was, is probably basically running out. And so get out. I would get out probably with 8 ticks, which is perfect, because that's where the bar closed. And then I would look for another trade. So you've got the tail, right, which says that, hey, we're bears, we're far below the VWAP, right? And we're interested here. We're not interested down here. We're interested in up here, right? Because if we're buying here, guess what? We want to go up here. Okay, so I'm listening. The buying continues all the way up here. Some selling hits them again. Obviously, we get down to here, but then boom, right? It looks like the Bear Bustion bomb went off, right? That's combustible bear products. And so they're getting blown out of there because bulls see prices far below the VWAP here. And so they didn't just dump a truck. They called the money factory and brought in trains of money. And so the bears are getting blown out here. Not only that, they're kind of too low below the VWAP. So, hey, if bulls want to draw price back up, that's all right, because we want to get back up above the VWAP so we can sell more. So expect that. That's the conversation that's happening here. Right. So they try it again, but basically what you want to do here is when this is 2 bull bars in a row, right? And so what you want to do is you're kind of expecting that price is going up. When you see this quick tail right here, okay, you got to get bullish, right? Not only that, you kind of got to figure that's probably the extent of the swing low, right? That's what this little red line means, like this one up here. Okay, and that's going to determine a lot about action later on. I'll explain. But basically, it closes right here. And so what you want is when price dips back over, you want to quick put a order right here on this spot, which is 24.20 even, so that when price runs back up here again, then you catch a piece and you get out. I'm not saying this is not my style. Maybe your style. Definitely is not my style in the S&P 500 anymore. At least not this time of year, this year. But I would just take a piece of this. I would not be interested in any more than a piece. Okay. And so I'm trend trading, but I'm not staying in. I'm getting out and then back in. So basically I break the trend up into a series, which is my strategy, but I consider that one trade. Okay. So here I've caught one piece. That's one trade. Now I'm looking at a second trade. And right here I can catch a piece, right? Because it does go up. It does come in. It does come in a little bit again, but did it stop me out? No, it didn't stop me out. I've got a stop 4 ticks back. Okay. So, wait, no. That one would have stopped me out, right? Okay, so in that situation, I'm going, okay, well, stick to a tick. If it does come back up, right, then it's going to trigger it. If it's going to continue, then basically what I'll do is I'll let price come back up. I'll put my other order here, because I do run a short and a long dome ladder. Okay, I run a short and a long one, and so basically I would let price come up, and then I would put a short order right here. But I've also got one over here, because look at this. You know, when you see this, you almost just have to invest right here, and then pull your stop order maybe back 6 or 8 ticks. Okay, if you can pull it back 6 or 8 ticks, then and maybe you can add more to it. But a quick tail that's that large, you also got to consider the volume here. So look where it moved, right? The solid part of the bar, very small. Look at the volume. It's like practically the biggest bar, and it's after a short bar. I mean, not a short price bar. It's after a short volume bar. So that's a castle right there, that volume bar, but it's got a short price bar. That's going to tell you something, that basically there's a ton of action happening right here. Okay, bulls are very greedy, right? Look, see this right here, this quick tail right here. Okay, you got a quick tail right here, because why? Because prices are below the VWAP, right? So they're very greedy for prices. And what happened when we got down here? They got extremely greedy. Okay, so you got to say, bears are going to get not only tired, they're going to start to lose money if they're short. Okay, and not only are they going to lose money if they're short, but looks like bulls are going to take prices back up over the VWAP, so then they can sell again. So it's just all, that's how it works. It's like a teeter-totter, right? You're just playing on the playground, and you're reading the teeter-totter. Okay, yeah, you already know what's going to happen, because this side's pushing up, that side wants to get things pushed down so they can get in at a better price, blah, blah, blah. Right? So, but you can trade this however you want. What I would have done, I probably wouldn't have pulled back here. I might have, but I actually didn't trade this today. But I would put a long order here again after I got stopped out here on this one, and then I would put a short order here, so that if it runs past the close on this bar, I'm in short. If it runs past the close on this bear bar, because look at this bear bar, then but I could be wrong about that, so I stick right here. But then I'm long, and so then I catch that one, and then I'm back down here again, right? So it's another one that I missed out on, to be honest with you. But and then in this case, I might have taken profit right here on 4 ticks. Okay, this trade would have angered me, to be honest with you, because it's all over the place. I don't like those at all. And it's just out of the norm, to be honest with you. Seems very robotic. It's not very smooth. Other markets are better. It seems like these days, like the oil and the gold. And so basically, you'd really have to pull back here and invest a lot more in this trade, which is kind of worth it, this quick tail right here. But I would have got stopped out twice trading the way I trade now. I would have I still would have put a long order in, okay, and I would have put it on either this close or this close, probably this close. And but the thing is, though, is I'm still not tricked right here. Actually, I think that would have triggered me. Maybe it depends on where I was in the order book. But so then basically I'm breaking even now. After I profit here, I'm probably just going to profit right here or about right here because it'll start to pull back. Actually, it started to pull back right here, so I'm going to get out about right there. And that's going to break me even. So basically this trade right here and this trade right here cancel out all these losses here, and that's even. Now that's okay, right? If you're trading like me, you just try to break even, okay? I'm not saying that you need to profit, because if you think you got to profit, you're not doing the job. This is a job, okay? This isn't the lottery. It's not something that, you go to the park and you try to hit the ball or throw the ball as hard as you can. You aren't doing anything as hard as you can. You're just doing it as long as you can. That's the difference. You're just doing something as long as you can, okay? It's not as hard as you can. And so if you're breaking even, you're doing the job right. If you break even more then you lose, okay, you're doing the job right. If you're losing more often, then, and I'm talking about by the end of the day, when you add up every day, if you have more losing days than break-even days, you're not doing the job right. You don't understand the traffic demographics of the bears, the bulls. You don't understand the crowd here. You got to understand the crowd. Okay, you got to get in. So that's how that works. So this would have broke me even right here. No problem. And I'm probably aggravated because I don't like breaking even, It's better than losing. Okay, so basically I would have put in let's see here. Dip down here. I would have had another one right here, expecting it to go higher, but then it did put me in, and then it stops me out, okay? So at this point, I don't know what's going on. That's pretty bad right there. I would have expected a trade to continue on, but I'll tell you what did happen here. Right here where it pulls back, that is all about, you're on the north side of the VWAP again, so the bears came back in. Okay, not a problem. And the bulls weren't there. Bulls are looking for what? They're looking, actually, in this case today, they're looking for prices south of the VWAP. And essentially, they were just waiting for prices to come back before they pick up any more. Also, all of these little battles right here told the crowd that the battle's on. The VWAP battle is in effect. So if you come up north past the VWAP, expect bears to come out, in formation. Okay. Not only that, you got shorts that are still in the market here. Okay. And so if they're still in the market, they're going to be in the market. I mean, half of these are robots. Okay. So they don't, they're reading the data inside the computer. They're not looking at this. Okay. And so they don't actually honestly know the crowd. They just know the data. They don't even know the data. They're something else. Okay. So they're a box of nails. And So what happens is when you get a bunch of people caught on the wrong side of the trade, it'll come up and then it'll always come back, and you see it comes back about halfway down to the low before it takes off. This is the cup and the handle. Okay. And basically you got this whole part right here. Okay. That's the cup, right? This is the bottom of the cup. You saw it. And this is the handle. Okay, that's the bottom of the handle. And so, you put your tea in here, you hold it right here. Okay. And these are this is predictable stuff. Basic crowd reading, what you do with these charts. And the reason why it happens is, one, this is north of the VWAP again, and you had this big bear victory, had a lot of bear victory right here. So because of the bear victory, you're going to have shorts in here. Computers are shorted, people are shorted, people got stops on. People just look at this thing, okay, yeah, blah, I'll put the stops right here or wherever. It's not that. It's that basically when these shorts are losing, they got to get out so they can control price. If you have millions to hundreds of millions of dollars, and you're with a crowd of other people that do as well, you can hit this. I'll show you. Okay, you can hit the dome, right? And it doesn't matter. How many sellers or buyers there are. All that matters is that how many are right here in the order book, okay, and actually how many are actually back behind this, which aren't even in the order book yet. But basically, if you can put so many orders on top of this, okay, you can push it down. It doesn't matter. Nothing else in the world matters. It seems like it does. It seems like it's a very big thing, and it would take just, the whole moon to be pulled down, and then you'd have to just total, laws of physics and gravity and stars and planets. But it's not. It's you can move these things fairly easily if you're in the right institution with the money and the know-how and the reason to. And so the reason to right here is that price is going against these bears, okay, and because the bulls took over here, well, it looks like it's going to be, if you see this right here, it looks like the bulls are going to win this thing, okay. So if you're bearish, well, you can't let that happen. And the thing is that the bulls got the price back up here above the VWAP. Okay, you got to pay attention to that. What that means is that they're not as greedy anymore. Okay, they were greedy down here below the VWAP. Remember, they get paid when they're past the VWAP. They don't get paid a bonus for being bullish north of the VWAP. They get a bonus south of the VWAP. Okay. They also have to take profits. So if price continues to run up, they take profits. Then they hope that price gets back down below the VWAP, and so they use those profits and so forth to get in lower below the VWAP. So that's the system. Okay. So there's profit taking. There's above and below VWAP. There's extra bonuses, depending on what your client wants. Okay. But the thing is, though, is there's no bonus up here for these bulls. So they start to pass out. And that's when the bears know, okay, they're starting to get weak right there, right? The necks is shriveling up, right? The bids right here, this is the buyers. They aren't as thick anymore. So what they do is they break that neck off, right? The bears break that neck off, and they double up their positions, and they push this price back down. It's almost always this cup and handle thing. The handle is almost always halfway back down to the bottom of the cup. Okay, and there's a reason for that. Okay, they just need to get out of their position. So if they all double their positions, okay, together, they can push price back down halfway. This is the routine. This is how the crowd works. You just have to know it personally. Okay. Halfway back down is break even. Okay. So, yeah, so they were wrong on this bear call right here. Okay. They were wrong. All right. Got Commander Bull here. Get out of town. But wait. One last battle. They push it back down. Also, you're above VWAP, so they're probably getting a bonus right here. Okay. And so they push it back down halfway. All these guys that were bearish, they get out at break even. Maybe they get out at a profit. You know, if they triple their position right here, they got a bear position. It starts to move up. They double it or they triple it. You know, whatever they're daring to do. And then they get out here at break even or profit, or maybe they take a little tiny loss, but it's not a big loss. And that's just how you play this. That's how you play it as size traders. Maybe not necessarily you, trader, you know. So that's what they're thinking there. And then you get the pop back up, okay? And normally in the S&P 500, except for as of late, then you get something called the bear squeeze, or the short squeeze, or the bear trap. Okay. And to tell you the truth, I would say that this is a bear squeezed. This right here is the bear trap, and basically what it is that you got a lot of bears that are all of a sudden buying. Okay, and so you got a lot of bulls that are buying as well. The reason why the bears are buying is because they got to buy to cover. If price is going against them and they're short, then they got to buy to cover. You also got bulls that are going, hey, we're buying here. No, sure, Sherlock. And then not only that, bears are going to go, well, I better buy too. Right? So they want to get into the long position. Now they turn into bulls. So they just metamorph. Right? And so that's 3 times the buying. And there just isn't enough sellers on the book here. There's not enough supply. And so everybody knows that. And that's what they take advantage of. They know that. Basically, when you get a short squeeze like that, most of the time, it basically takes a moon to crush it because there's just so much activity there, just not enough supply. You can move in enough supply, but generally you don't want to, because if you're going to go short, you want the move to happen, and then you want to catch the upside of the move, right? So if you were short here, and then you see this bear squeeze, okay, well, you want that to happen. You want it to come back up before you take advantage of it. Not only that, you know everybody else does. So you're just going to let it happen, and then when it gets up there, then you start to bear it down, right? Because you got higher prices. Or basically, to you, it's lower prices if you're a bear. And so it's just a teeter-totter kind of day, right? That's the playground. It's all playground physics, you know, swings high, swings low. Bizarro World is the oddball robotic trading. And I think Bizarro World kind of kicked in about right here. This is still a little bizarro for me, but let's see, what time is it? An hour and a half. It looks like it kind of kicked in an hour and a half, maybe 2.5 hours. But that's when the computers kind of take over, and the crowd kind of goes away. Once the computers take over, you know, they're operating on nanoseconds. They're not looking at charts. It's a totally different case. But anyway, you get your cup here. It does make its move up here. You got the quick wick. saying that bulls are out of here. You know, ain't no way we're buying anything here to go up here, right? Do you see anybody buying? No. All right, so 1, 2, 3, 4, 5, 6, 7. 7 bars like that. That's meaning that. You know, you're getting stagnation, right? It's like a dead zone. What's wrong? Nobody want to buy up here or what? No. Okay. But you keep on getting a few little interested here, and a lot of times what's happening is that some people are actually switching out their positions, right? So they profited right here. And so what they're going to try to do is they're going to try to sell a little piece here, right? They'll sell a little piece here and take profits, okay? And then it comes down, and then maybe they'll even buy some. Who knows? But they're not going to sell more because they want to sell more up here. But then it comes back up and they sell another little piece because they're looking at the volume or whatever. It does the same thing. Oh, whoa, it's over the line here. I'm going to sell even more. So that's what that quick wick is about. This is a doji, meaning that you got high volume. And the bar didn't go anywhere. It opened and closed at the same place. This one is also a doji. It's still small enough to be one. Okay, it wasn't effective, right? This was the effective one, but it really wasn't because the trend continued to go down. So you got the higher volume though, right? That higher volume's got to stick out to you. First of all, you know, it's kind of ranging right here. This isn't much higher. So really that was 7 bars, 8, 9 bars here, technically. Okay. And it's just ranging. And you got the doji, you got the high volume, right? Everybody's going to read that. And they're going to go, well, I'm not buying anything now. Look at this. Right? So without the buyers, the bears can easily take over. Okay, and so with the bears seeing this, they know the buyers aren't going to be there. So what do? They short it, and they also take profits. So that's what starts happening. Rip, right? That's that bear ripping down. That's what that is. That's his mark. The quick wick, rip. Okay, so, you know, you get in short here. Not a problem. And, you know, with these many bear rips right here and this much consolidation, okay, 9 bars, I would say, yeah, I think there's enough bears here in town. We are north of the VWAP, so probably I would probably basically be backing my stop up even more. I would actually, basically by backing my stop up, I'm investing more into the trade. Okay, I'm willing to spend more. Right. So, but if the trade goes right, then I didn't spend anything. But if it goes wrong, then obviously I paid for it. And so that's... Then work it on down. I think, you know, in the S&P 500 E-mini, I think these days you got to go with 6 to 8 tick stops. That's what it's looking like to me. Whereas before, I think you could have done pretty well with a 4 tick stop, which makes it mighty expensive. You know, I tell you, the 60 euro and the CL oil and the GC gold are probably going to be a little more. If you're just starting out, now if you're a bigger player, then that's not for you. This would be fine. 6 or 8 tick stops would be okay. If you're just starting out, then this would not be okay for you because it doesn't fit your budget. Okay, it's not financially feasible. So I would have worked this trade so that basically I was probably profiting on this range, and then my basically my theoretical average, right, where I break even, would be somewhere way up high. It wouldn't be right around here, because I would have profited already. I would have taken a piece. It would have come back up. I would have said, okay, I'm getting again the same way I just was in. Took another piece, and it comes back up, does the same thing. I'm saying the same thing, you know. And so every time I take a piece, my break even goes higher and higher, because the price actually has to go that far against me that much more before I actually lose on this trade, which is that I am looking for this move. Okay, and let's take a look at these volume profiles real quick. Right here on the top right is the S&P 500 E-mini. This is the 5-day, 5-minute chart. It's not really telling. Let's look at a hour. Looks like the VPOC is down here. Right, you got you got the FOMC coming in, and VPOC is probably going to get hit this week. I expect VPOC to, for the market to come talk to VPOC and probably bounce off of it after the meeting Wednesday. Maybe it'll pass through and go on down to here, but this right here, right? That's the I see what it did right here. That's the support. Price did come down and bounce off there, and so what was I saying here? Right, so actually that's what this was about. It was bouncing off of resistance. That's why all these bulls were in here. Okay, it wasn't just the VPOC thing. It was that not resistance, that support line, the big support line on the day chart. Okay, so then we're back up here and it's not working. So what they're going to do is they're going to test it again. Right. Looks like they're going to test it. Bears are just shredding these things. Not only that, you got to be aware that it's FOMC week, so there's not many people in the market. And, try to take a gulp out of this. Once it gets down to here and then it starts doing this, I would probably be out of here. That looks like a big pain. And but the thing is, though, is that this might have got me interested, but I'm not seeing, bull bar after bull bar. I need to see more bull bars to get me interested, and then I'll start picking off the closes of the bars until they stop me out. This one is closing on the 34. I've got the 34 EMA here, which is basically the middle of the road. And then it does it again. So I'm thinking that one of these I'm going to pick off, right? So if I pick up either one of these or this one, maybe I wait till this one, maybe I get this one, whatever. If I'm really convinced, right, I think this is still in order. I think it's going to come back down here. I got to check that day chart to see where resistance is. And if I still think everything's in order and I just don't think that it's going to go up there, look, right, so what is this? You got tops out right there, tops out right there. Okay, right on that 34 EMA. That's telling me. It's also telling me there's no more, bears aren't so greedy. It's also 9:30. the days before the FOMC is kind of like a Friday, it's like a lazy Friday, and so I definitely start to look at this, but I definitely take this trade right here, and it would work out. I could get 6 on that easily, 6 ticks. So I'd be positive right here on the day. I don't think I would trade this. I'd take a piece there. I'd see what's happening. I wouldn't trust this. Because it's not far enough away from the 34. Or the 34 EMA is basically the VWAP. But the 34 seems more accurate most of the time. And but and basically when it starts talking to the 34 EMA very well. So it bounced here, almost right on the line every time. Okay, that's telling me that basically it's pretty bearish right here. So this is investable. Okay, but then we get back down to the support, and we're not going any further. So then that trade's kind of over, right? So start looking the other way, and you got this one right here. I would say, yeah, that one, put in a buy right there, and you'd get it. You'd get your 8 ticks, right? I would only be taking 8 ticks out of here at most. And if it starts backing up, then 6 or 4, I'm good with that. So then, grab that 8, throw it off the table, get it out of there. You got another failure right there. Right. Bear comes in there. It's a quick tail. So, it's a failure. And so it fell. And at this point of the day, I'd probably just be aggravating. This is like a dull Friday with the robots controlling things. I don't think I want to be in it. There's not many trades. I'd be looking at other markets. I'd be more interested in over there. Here's the oil. Let's take a look at the volume profile on the day chart. Looks like we're bouncing off of a line of support here. Big bounce right there. Okay. But got big volume node right here. The volume point of control is up here, obviously meaning that this is a point of consolidation where you get a lot of bears and bulls trading hands here. That's why they got the VPOC up there at the top. But you got a big volume node right here. And if you know the news, basically you know that the oil is in a situation where the OPEC has the bulk of the oil market in the world. I do believe, I'm not 100% sure about that, but I do believe that that's something that they conspired and have achieved. But the problem is that for them is that the fracking technology is so good now that anybody can get oil for dirt cheap. So there's drillers all around the world. There's entire countries that didn't used to put oil on the market. They're putting it there. And you got a lot of oil sitting around above the ground. I mean, you could just, before it used to take you 2 years to get a well going, now it takes 2 days, and then all of a sudden you got it. And it doesn't even cost that much anymore. Not only that, the technology is so good that it can reach more of the oil, and the technology is so good that they can find more of it, right? So between extraction, finding it, and reaching it, the oil market just got that much bigger, right? And so whenever you got more of something, then obviously the price is lower. Not only that, you got more competition, right? So if it's easier to find, easier to get, and you can get more of it than you could before in the same places, then all of a sudden you got more drillers, right? And they hang in there longer. It's harder to get rid of drillers. And so basically the only way that OPEC can stay in business, which is Russia, all the Middle Easterns, the commies down in Latin America, you got some of them in Africa, both kinds, and the only way to compete with those groups, those are elitist groups. They got nothing to do with the people, but the only way to compete with those groups is basically they've got to cut. It's actually up to them. They're in a noose. They have to cut their own rope. They got to stop putting as much oil on the market, and they lie. They say, "Oh, we're going to cut some," and then prices go up. But then everybody finds out they lied, so prices go down. And then their word doesn't mean anything, so prices are just going to continue to go down. The other thing is that when prices do go up, then everybody else, such as in America, everybody else starts pumping more. They turn on more rigs while the prices are up. When prices come back down, then they turn them back off. But OPEC needs, because they depend on oil so much, right? They don't know how to let people work and make money and then function, right? They need oil to function, and then they keep the people shut up and shut off, right? So they could tap into the people like in America, and they would be just fine. But they can't do that because of, I think it's because of their education level. They don't know anything else. But that's not necessarily true. You could be highly educated and still not get it right. Get it right, you know. But the only way they can get prices to go up is to let go of market share, which gives everybody else in the world more of their market share, which they eventually they'll give up so much market share that their governments are going to collapse. And then they're going to depend on the central banks even more, which gives the central banks even more power because the central banks are getting paid the taxes, what taxes that they do make, because they barely have any consumers, you know. And so then they start tapping into the rich people, right? And so that's how the central bank empire, which is European based, it's not primarily based on any others other than elitist Europeans, which are remnant royal families and constituents. And so that's how they start to, they have fracked the elite accounts, the elitist money supply in other countries. And that is a form of warfare, by the way. Not a lot of people are enlightened about that, but the information's out there, and people should be more educated. And the thing is, though, is that it's free. The education is free and factual. You can verify all of this. And being that it is, more people do curate the information, then reproduce it and teach it, and the word spreads. And so eventually what happens is that there will be so many people that are aware of this subtle warfare, which appears to be about something else, but really what it comes down to is what I'm telling you about, tapping into people's pockets, governments especially, rich people's especially, but they will take the middle classes and make them dirt poor, They will throw a war on you. They will plague everybody with cancers and mental disorders or whatever, and then they'll sell you medicines with oil in it, whatever they can do to get a revenue on mass levels, make you more dependent on government, which is dependent on their money supply. They import the money from a non-territorial nation or empire. Then all of this medicines to cure cancers and mental disorders and people being dependent on the government, it all gets those donors to put more money on the government. It puts the government to draw more money from the central banks. And not only that, they get to tax all this stuff, right? So they tax the water, they tax the food, they tax the medicines, right? And so the government gets all those taxes, which go to central banks, which gives them more power to buy more government people, more assets, more industries, more military complex, more education, more news, more information control, and basically everybody's kind of on their religious puppet strings. And to tell you the truth, it's very erratic, and it reminds me of these robotic markets where things are so irrational, they're hard to invest in. People are harder to predict and depend on and trust and get to know. They become very materialistic, and the people in California say plastic. People are more plastic, or artificial or fake. And California is very socialistic in nature, which is a construct of the Marxist central bank New World Order, which is a religion, which is a mass paradigm. It's an empire. It's a belief system, okay, to put everybody on their money monopoly Ponzi scheme, which in the end weakens everybody, and then they take you over like the General Fabius of Rome that would weaken the country or weaken the armies of Hannibal. And then once they were weak, then attack, but don't attack until then because it'll cost too much. And then in this case, in the case of Marxism, they make quadrillions of dollars. In fact, they've made so much money now over the past 300 years of this ongoing central bank war that they can literally buy the wealth. And remember, money is just information, right? But they control so much of the information beyond money, right? The contracts on the assets, the land, the businesses. They control the laws, which is information. It's all information, right? And technology and so forth. The people that are pulling the strings for them, who are the assets, right? Because they have the knowledge wealth, the wealth of knowledge. All of this is information. They control it. They control enough of that to buy the world 4 times. So what people are noticing is that their movement is getting faster and more effective, right? It's more effective, and it's going their way faster and broader. And this is why, okay? And it's mostly, I'll tell you what, it's mostly because they've got it down to where they can basically, they have changed the way that the people think in Europe and in the USA and Canada. Probably Canada the least of all, but definitely much more in the metros and the very densely populated Europe. And a lot of it does have to do with physiological control, right? You know, if they can get to you biologically, they can make you more dependent and less apt. If you're less apt, it's easier to give you what to think rather than you be out there independent, figuring out what to think on your own. Well, I think I went back into that subject. That is this subject. That is, I shouldn't go into it over and over, but I will. And you know what? That is the news of the century. That's not just the news of the century. That's the news. That should be the biggest story. It is the biggest story for the next 10,000 years. I mean, you can't forget something like that. Does anybody forget Rome? No. This is as big as Rome. This is as big as the Khans that took over all the China and Mongolia and so forth. This is as big as any of them. I mean, this is gigantic, and they've just begun. They may continue. I don't know. They are deadly. This has gone on for 300 years, and they existed practically unknown. How many people know? There's more now than ever. That's for sure. But previously, there were very few. And really, what can we do about it? I guess teach more people. The thing that they benefit from is that information traveled very slowly. Very few people knew anything about these things, politics, economics. They didn't know who was trustworthy or not. The internet tells everybody. It shows who's trustworthy. If you care, you'll find out. You can find the information, right? People like WikiLeaks and that kind of thing. They can get in, and they can extract the information about these bad players, and they can put that on the internet, and then everybody finds out, and so they can't get their people into office, which changes the direction of the entire world, right? So before, they were kind of like the parents that were just telling the kids that, blah, 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 and the kids wouldn't even know anything about what's out there, and so then they leave the house, and then the kids just assume that, well, they are who they say they are, and the world is what they say the world is. But now, we're all the kids, but we've got the internet, and so when they go out there, we have like this kind of like three-dimensional kind of perception now. The eye of the cyber public is everywhere. They have computers on them. There's computers everywhere. You can't if you're a high-profile person and you're up to no good, you're the most watched 24/7. You have governments, private individuals. You've got everybody just extracting information all around you. Whatever you say, anything, you're always watched because you're such a high-profile, person. And if you're a nefarious person and a high-profile person, then you're even more scrutinized. You're like a whole coral reef, and all the eyes are on you. And the sharks, the sharks are in there as well. And so now they're the children, right? They're the children, and they don't even know. You have to understand that this has just begun. You are on the precipice of an entirely new volume of civilization. You are where one is coming to an end and another one is starting. Very rare does that happen. The last time that happened was something like 10,000 years ago, when they figured out how to centralize control over people simply by controlling what they think, right? Think the pharaohs, think the Hindus and the Buddhists in India, right? With the Vedas and all that, okay? And then it kind of stems out from there, and you got the ideological era, with all the kings and the different cults. There were thousands of cults, okay? Kings saying laws and stuff, controlling this and that, controlling prices and everything. Prices is what you think, right? It's a belief, okay? And then things did kind of narrow down eventually after several thousand years, you know. But I mean, try to think about it. Think about 3,000 or 5,000 years from now, right? As if 3,000, 5,000 years from now, then things will start to get more, to narrow down. But like you're in the middle of the ideological era where you just got cults and kingdoms popping up and disappearing all over the place. Every 100 years they're just up and then they're gone, and one leads to the next one, to the next one, to the next one, century after century after century. And, try to imagine that. Now we're at the point where technology is affecting these things. So these liars, right? These mass murderers and liars, cheats, the political rush is over. They can't just get up there and spew total, nonsense like a witch pulling strings on the minions, and then they're conspiring to go out there and cruelly beat everybody who's defenseless in belief of this and that, and these huge masquerades and orchestrations of idiocracy and death and slavery. Now whoever's doing that are the most eyed people there are. You can't just do that. It's not a free for all. It used to be a gold rush. It used to be an oil rush. I call it the political rush. That's what it was. All these cults and kingdoms and stuff, right? Demagogues. They're all demagogues. It's the political rush, and it lasted 10,000 years. Now we're getting to the point where we're at the 180 rush, which is the exact opposite, right? Where the business of the people is more powerful than them, because what's going to happen is when they go out there and they walk into this wall of cyber public that knows everything. Okay? I'm sorry I got off my charts, but this is, it's just something that is profound. It's just the most fascinating thing I've ever discovered in my life. But, when these people go out there and they walk into this wall of cyber public, okay, they have to be even more perfect than ever. They didn't have to be so perfect until America came around. And so America did a good job at, using the democracy, using the republicanism, that constitution thing, okay, with the various states. What it did was it filtered out a lot of the criminals. And so it kind of left you got the fools, and then you've got the wise experts. And so if you can get away a lot of the corrupt, then you have a better consistency of leadership in the local and the federal governments, which affects the leadership in all the businesses and the public, the general public, even in the schools. So, in the past, you would have corruption on top, the top tier. Like, think of a caste system where the most wise, corrupt, evil people were on the top, and the most wise, good people were on the bottom. The fools were in between. Okay, and that's just how it was. That's how it is in a lot of the places in the world. But America came around and it legally slammed because of the Christians. That's how Christians think. They put the criminal corrupt down on the bottom tier. They're the untouchables. You don't even dare be affiliated with them, and let alone ever vote for them, right? And so you don't even go buy their stuff. They're out. And so the United States had filtered out a lot of them, right? And so exponentially that did really well. Now, it was impossible to keep out the central banksters. That's why we're at where we're at. We're lagging now because of them. But now we've got the internet. We've got the blockchain technology that's going to do something about this. And so we're beginning a new volume. But we couldn't have got here without the Christians and the Constitution.
There's just no way. Christians made Europe. A lot of, I get this all the time that, oh, well, because white people are white, that's why you got Rome and Greece, why Europe was so successful and creative. No, it was the Christians, right? I don't know 100%, but I do know that the Jews had the first republic. And the Europeans did take on and become a republic and did very, very well with that, see? But why would anybody think of a republic? Because their religion says that, the people are more important because of that's the way that nature is. God is the nature, and there's no need for a king, right? So the people are more important. So Rome tries it, and they did very well. Actually, they did better than anybody ever in history back then. It wasn't because they were white. A lot of people think that. My people think that. And and then Christians take it even farther. They take it even farther. And then, of course, they're all in Europe, and they raise the bar. They make Europe a very fascinating place. And I mean, if you weren't Christian in Europe, you know, everybody went to church. Everybody knew the lines of the Bible. Okay, you know, and then they moved to America because they had made the elitist royal people so rich that when the Bank of England and later on the Rothschilds combine with the English or the British royalty, then things get really volatile and really evil. So English travel and get over here to America, start to colonize it. Other people follow suit, and then of course England comes to test. They got the central banking scheme going on. They're trying to raise hell around the world. They got to pay debts. Everybody's their slaves. And so when they put us to the test, then we fought back and beat them. We did have help with the French, from the French. And so we beat them. We didn't run out of money, which they were hoping. And so anyway, you know what? I'm going to change the subject here. That is the biggest. That is the biggest news. I'm sorry. I'll make another recording about this. I'm just going to skim through this and end this. I think this is probably over the hour mark. Let me see if I can tell. I can't tell. Anyway, so that was the volume profile. Volume profile, got the node right here. You got the, looks like the point of control way up here, but you got the main area volume right here. So you would expect that there would be some bouncing between, between this area right here and this area right here. So, it's not a myth. That is just what people read on their charts, and that is what they all agree on. That's what the crowd thinks. Okay, and the crowd thinks things for a reason. Here we go. We've got the swing low. Hold on, excuse me. I'm really stuffed up here. Sorry about that. And then we've got the swing high here. So here we go. This bar is not really effective. It's the first bar. I never believed that. We get up here to the third bar. It looks like it ends. Looks like this one, it just continues over here, but it's not going higher. That's telling me something. I better zoom in because I know it's not as clear on this video. Gotta stay in. Right. Okay, so what would I be doing? I would be avoiding this. Look, when your price is around this 34 EMA, okay. Basically, what's going on here is that it's about as good as a 50-50 bet. When your price is above EMA, okay, you're either trending up, and there's a way to tell because you can look at where the price is bouncing off of support, that kind of thing. But it is not trending, okay, and also it's not reversing. It's not way above the 34 EMA, and then reversing and then trending back down. It's not way below or leaving the 34 EMA to the downside, and so you're stuck right here. Look at this. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13. 13 bars. That's what is that? That's a half hour, actually. A little over a half hour. And still nothing's happened. But basically I would do this. I know how I looked at this morning. Basically you've got this top here. Okay. Do I have this set right? You got this top here. This is basically the top. Okay. Look at that. Okay, it just gets lower and lower. It's still all histogram down here. It's all bearish red. And this is indicating that there's some downward coming. And so it would be a good place to get short. And when you see this right here, you're going, yep, right, because it reversed. Okay. And so you're going to take a shot at this. Now, it depends on where you get in at. If you're seeing this and then it obeys, see this one right here? It obeyed right here. Came down and then it comes back up. I might be tempted to say, okay, it's not going to go up, right? And it didn't go lower than this. Didn't go lower, but it's not going to go up. I might be tempted to actually take a shot right here. If I take a shot right here, I'm going to do okay. But I probably won't because I'm still too close to the 34 EMA. But I do have this trend right here. It is slumping. And what I'm looking for is I'm looking for a big sell-off, which indeed it actually wound up doing. It actually wound up being a really good trade if I stuck to it. Okay, that's pretty good. Now these are 10-cent handles, which is $100 per contract. Okay, so this right here is 2 handles. It's $200. You could scoop out 100 out of that pretty easy, maybe 150. It depends on how you do it. But basically, might have missed this one, might have got this one. Then it reverses on me. See, I don't like that. Then I see this. This was telling, right? Look at this. This is a whole handle. These are half of handles each, right? That's a lot of the bears are just killing that, right? And you're above the VWAP. Okay, you got this over here. So basically, it's telling you that you should be short. You should be working some short patterns. Now you work the short pattern in the long time. That's your focus trade. But on the side, you're also working some counter, some counter trading. It depends on how you do that, but basically what I do is I work 2 different strategies at the same time usually, and that includes the focus trade, and then also basically I'm just trying to strip corn off the cob. I'm not trying to get big swings on the second side. I mean on the side there. I'm just getting little nibbles. That's it, little kiblets. And basically what that does is it not only funds my focus trade because now I can let the thing, go back a little bit more. I can be a little bit more lenient on it. But also, if I do happen to lose it and I get stopped out on my focus trade, then that evens out that loss. And normally, if you do it so well, then basically you wind up with more from your side trade than what you actually would lose if your focus trade does happen to lose. And so it becomes that you can't lose on your focus trade if you're doing it right. And it takes practice, and you also have to be quick. You gotta be kind of smart to be able to do it. You gotta be able to recognize everything that's going on, and then predict the future, the most likely, what's going to happen and why you got to do it, which is kind of a interesting interesting subject to discuss sometime. So yeah, that's that. I'm going to have a drink. So this looks like a loser right here. And then you've got this. This is a loser as well. So I'm going to be shorting, of course, and continue this downward assumption. And I would grab a piece of this. I don't know what I would get right here, but I would get something. I didn't even trade this. You know what? I was just, it's a FOMC week. I'm not doing good, so I got out. I just didn't want to bother with it. I was interested in the news. I was doing something. I was writing something. I was talking to people, and I got out. But anyway, but there's a piece right there, and this is why I would have got a piece right there. I probably would have got a piece right there. Could have lost a piece right there, but then I would have got it back. And then I got some range right here, so I could have just kept on, nibbling on that, right? I call it... can call it corn rolling, I guess. But anyway, get this. Okay. So here's the thing. This is the real crazy thing. First of all, you got this big volume right here on how many handles? 2 handles. Got the big volume right here on 2 handles. And that's saying that things are ready to go up. But I'll tell you what, though, because it's 2 handles, it's a 2-handle price bar, you gotta take that into consideration. Now, if it was like a half a handle, the big volume like this was on a half a handle price bar, then that would make it significant, and you would say, okay, this thing's reversed and this thing's headed, so you got to take that into consideration. This actually, basically, it gives it about this much value right here, okay, because of the fact that this is 2-handle price bar, a lot of volume, but it's 2-handle price bar. Half of a handle price bar, then we're talking about a lot of volume. Meaning that there's a big reversal there. So, and then it does keel over right here. And if you were long right here and you saw this, well, you're getting out of this trade. You wouldn't hold on to that. Okay. And then things do wind up selling off here. And then look at this. It comes down. And then what this is not all selling. I'll tell you that. This is a lot of buying right here. Normally, you got to consider these big volume bars that stick out like this as indicating that there's a lot of pressure in the opposite direction, okay? And then what you would do is you would test it, okay? So this is indicating that it is going to reverse. And does it reverse? But this is indicating that it already reversed, right? Hold on. I got to give you an accurate read on this. So this thing's already trending. Okay. Yeah, exactly. Okay. So this thing's already trending. So it's going down. And then you get the big volume bar. And then it basically says, okay, we're reversing. Now over here, we were going down basically, then we were going level. So it was down and then level, and then you get the big supposedly reverse bar. It's kind of a reverse bar. It's kind of not. And then it reverses, right? So you're going down, then reverse, down, and then reverse. Got that? That you got to be able to read that to get that right, and I hope that's clear. Okay, these are reverse bars, and the trend is going down. The trend is going down, and these are reverse bars. So basically, what it means is that when we get down to about right here, then they buy a lot, and they shake it up. And that's what they do on the oil market. They shake it up quite a bit. And then you get over here. You've got the bear right there. It's a quick wick. You got the level right there. They just won't beat it. They give it another try. Look at that bear right there. You got one bear, two bear. Right. This is failing. You see all this right here. You gotta short this, right? This is begging to be shorted, okay? And so you get a piece right here. Now this is a lot. This is about between here and here, and you probably want to start up here. You're gonna work out a position like up here, okay? Now you can corn roll this, like I call it, which means that you've got a focus trade that's going this way. And then at the same time, you're going to try to pick off pieces so that every time the price comes up, then you try to grab another piece, another part of your position. And then when it goes down, you grab some. Don't be greedy. Just grab 2, 3, 4 ticks. 4 ticks at the most. Okay. And then get out of it. And if it happens again, do it again. And the thing is, though, is that if the price will let you get in higher, right? That's what you want to do. So basically meaning that if you're bearish here, a higher price is a lower, is a lower sale. It's a better sale. So you want to get that. And that's what you're going to try to do is work your way up. But if you've hit a bunch of these, you're already profitable. And so you can actually move your stop back, a little bit more, which you ought to do anyway, in this scenario. So the focus is short, and then the corn roll on the side strategy is the supplement. You're going to finance the loss on your focus trade. So just in case, but you wind up profiting when you're right. You might even wind up profiting when your focus trade is wrong. And so here you go. You got one handle, two handle, 2.5 handles right there. You could have definitely got one handle easily there, 1.5 handles. And this is actually a 2-handle move right here. I would be interested. Yeah, right here. Here's the trade. There you go. Here we go. Let's see. Nope, that's the circle. Excuse me. So you get the bounce right there, and then you run on back down. So that would have been another handle or handle and a half, but you could have easily got a half handle out of that, right? So that's what you got to do. You got to decide, hey, look, I'm not necessarily going for a whole handle here. I'm not even going for, not even going for 3 handles or 30 ticks or whatever, whatever you think is a good home run. You're just going for pieces. And as long as you can do that and you've got good enough reason and you know how to finance your focus trade, right? So this one right here would be a focus trade, okay? Look, it bounced off of that line and then it failed. I would enter somewhere around here, somewhere in this handle right here. And then I'd get out, probably about halfway down to the next handle, But in actuality, I could have held on here, but I don't know what this is going to do. I mean, look at this. This is 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11 handles. And you got MACD coming here. creeping back up to the green side. So, you don't want to be down here. Look what's happening down here, right? You're going to bounce the checkbook. So that would be a no-go for me. This would be about the extent of my mission. And then this is late in the day. This is getting close to the close. The only trade happening here is this one right here actually could work because you're away from the 34 EMA. The MACD is trending green now. It trended up here, so that's greenish. That's green wise. And so what you're doing is you're looking for that greenish move. Right? You're looking for a reversal sometime in the day anyway. That's just what you do. Okay. And generally these once the volume peters out of the market, once the volume has petered out, then basically the reverse move is really good. Okay. So you're already down quite a ways here. You got a lot of red right here, and volume's gone in the market because this is 4 hours into the market. The market's pretty good for about an hour and a half to 2 hours and a half. All right, you can't add that. So, this is worth a trade right here. This is what I would be looking for. All this way right here, yeah, I would be looking for that. And then you could get another half a handle. Okay. Don't be too greedy. You can hold on for that. It's like 15 minutes. 15 minutes is a lot to some traders, so it is a lot to me. And then I would never touch on any of this. And the reason why? Because they're extremely volatile towards the close, right? Wherever that close is at, it's going to basically what it is they got to close out all these positions. You got market makers that aren't really even trading. All they're doing is facilitating trading. Okay, they got to get out as well. You got everybody that was in the market, they got to get out. You also got to get all the people that they got to close out the remainder of their trades, meaning that they came on the market with so much to put on the market, they didn't get it all on the market, and so now they got to just hit the market for whatever they can get and get rid of that order that they got to fill anyway, anyhow. Otherwise they ain't even going to survive to see the next day. And so when it comes down to that survival to the next day thing, then it's just really close. It's too close to call. It's too choppy. It's closed. And so, I don't even bother with that. I'm out. And let's take a look at the GC. And then I'm through. Have extended this video beyond. All right. You see the sawbone. All right, so I'm looking at the open swing high is not really much of one. The open swing low is late in the day. This is the GC. I was going to take a look at the Euro too, but forget it. This here is the resistance. It's bouncing off the resistance there. Okay, you got another resistance right here, right? So this is not tradable. Boom, boom. This could be tradable right here, right? You're also looking at quick tails right here, so it's kind of like it's a toss-up. How would I do it? I'll tell you what I would do. I wouldn't trade this. It's too early, and this is not enough. This is not enough information. This actually would be deceiving. Technically, I could say, well, that's bullish because of the quick tails, but it wound up being bearish. You know, these are too little. They're actually not enough to trade on. This right here, though, that's enough to trade on. Okay, so let's see. This closes. This opens up here. It bounces off of there. I would say since that bounced there, that would be worth a trade. And you can grab a handle off of that, which is 50 cents. Yeah, so 50 cents on the GC. And then it seems to be trending, so I'm looking for more bear bars. I got a lot of bear bars here. I got 3 in a row. So as soon as it pops up over the close, I'm going to put on another short order. I'm also going to keep a long order probably about right up here, somewhere up here. So I'm playing both sides. I don't know which way it's going to go. This obviously is the close. It obviously went up and then back down. So I got that one. And I get a good run. I would probably only take... It depends on how fast it moved. I don't even know. I wasn't trading this morning. If it moves like a lightning bolt down there, then I would be getting out somewhere around here once it starts talking about a bit of a bullish move or something. And I would just get out. If it was a slow move, you know, and it really took all like 3-5 minutes, then I would probably get out somewhere around here with 2 handles. And then I would look for something else. Now I've got to take notes on this. That's a quick tail. I got to take notes on this. Right, hitting a quick tail. So that is a definite bounce. It's a hard bounce. Right, you can't miss that. It's 2 quick tails, extremely bullish, and bounced off the exact same price. So that's a definite reversal. Also look at the volume on this. See this right here? This is a doji with the big quick tail. A doji with the big quick tail. I think they actually call this a hammer. I don't care what they call it. But basically you've got open and close right there next to each other. You got a big quick tail. You got these huge volume. That's a reversal. And you got the bounce right there. So this is money. This is actually really big money. This is where you want to back the truck up and go ahead and dump like all you got. I mean, not literally all you got, but basically you want to hold on for the ride here. Okay. And so when you know that, you know, and you're doing this right here, right, you can see that you've got a range right here. So you've got a range right here. And, you know, you're just going to be corn rolling, you know, all of this to make extra money. Right, so this is really good. So you got the long focus trade, you got the corn rolling here, and you combine the two, and Viola, you got a really good trading day right here. This is the best one I've seen all day. The other ones kind of drove me crazy. I wish I would have looked here. I should have looked here. Got one trade down here, good trade, real good trade right there, and then And you got the reversal right there, and that really makes your day. Now, if you can get that right there, you got the trend down, and you're gonna get the trend up. Very easy to read. Traffic's going well. You know, you can clock out right around here. You might look at this though. So you got a bear claw right there, right? Right, scratch, scratch, big scratch right there. That's the middle finger, I can tell. And you also got the swing high here, so it's not passing the swing high. And then, so you got a drop right there. That's tradable. Okay, I'll just tell you how traffic is looking. I'm not going to tell you what the trades are, and then I'm going to cut this video off. But so if you can, you see that bear claw right there. It's failing. This is a squeeze right here, right? So this isn't even normal trading. Remember, if you got a bear trap, which means that the bulls are winning, the bear's got to get out of town, right? And then you get back up here, but bear's got to get out of town. So you're going to have a whole bunch of buying to cover. When you have a whole bunch of buying to cover, you've got, and really it happened right here. Here's the bear trap, right? Because this was the level that was going to make or break this downward trend, right? So if it pops over this, they got to get out of town. When they get out of town, they got to buy to cover. When they buy to cover, it's going to signal everybody else in the whole world to buy at the same time, because bears got to buy to cover, right? You're winning. You push them back into their own end zone, right? And so when that happens, everybody's going to get on top of that thing. So it's really a deadly time to be a bear. But the thing is, though, is bears is quick. They're just going to go and buy this thing because they knew what was up, right? So they're just going to reverse their position. But if they have a really big bear position, then obviously you get the handle here, right? So that's what happened. Was you got up here, then you have the bears scratching at this again. They won out. They're in a coffin. Some are still in there. Okay, they still believe. Well, whatever. But the thing is that they push it back down. They get out, and then back down halfway, guys. Back down halfway. Right, so they can get out without losing. That's how the size players are. Now, most players, if you're a size player, you don't listen to videos like this. So it doesn't apply to you. All right, I just see this right here. Look at that. Okay, so kind of ranged in there. Actually, this one too. I actually don't like ranges. I think they're harder to read. They're not as dependable, and so I'd probably be ducking out of this. So anyway, there's tons of money right there. I think that'll do it for today. Good luck with your trading.